this, that, and the other. All right. Hey, traders. Okay, so I wanted to go over today. Yesterday was really interesting. You remember that we had the Bears get stuck in a pickle. Well, let's bring it up on here so you can see. The Bears got stuck in a pickle, if you remember, and they were trying to cash average out of their loser, which I think was the wrong choice right here. And the Bulls were not acting. There was no action by the Bulls, and the Bears flexed, you could see. So they came down. And at that point, the Bears, who were in short positions, wanted to buy. So they were trying to bring that cash average down. And the Bulls got liquidity right here. So they were wanting to buy. So that gave us both parties wanting to be on the long side. So it was a pretty good call to say, hey, this is going to move back up to the highs where the stop losses would be sitting about here. And that's about even where it opened today. So no trouble there trying to figure out what the market's trying to get done here as it's pushed down, opened up today. So this morning, what we were going to be looking for was elasticity. Do you remember that? So elasticity is a format for a burn-off. And a burn-off is where you have high levels of tension. So we had 65% going into, what would I choose? Sorry, I got a text. What would I choose, cats or dogs? Cats. I'm a cat person. Okay, negative 65% into the close, which is pretty high. So the market wants to burn off that high level of counter force. So you push up, right? If you look at tension here, you push up. That's an upward force. The counter force is tension. It's what's pushing back. So you can see the market sort of burned through a little bit, still 46%. So even trying to burn off some of this high level of tension, the market's not really worked through a whole lot of it. Let's look at how that worked. Like, how does that work? How do you burn off tension? Well, there's a couple of steps, and we went over these yesterday. I'm going to go over them again. A, or 1. You want to see the controlling party fail. So in this case, it was the Bulls fail. What is failure? It's when you have the Bulls are presented with liquidity and they do nothing. And that's the little head nod that's like, there you go, Bears. You can take control of the market, burn through the tension, and we'll get a better price. That's what that would be. The next one, B, would be motivate Bears. And I distinguish this between Bears acting because if we don't have a context that's going to motivate Bears to act, you're not getting an elastic market. C? Okay, so let's go back to B for just a second. Why would this motivate Bears? Because we had 65% tension here. That was really 65% tension. They were motivated to pump this down to 0. They saw that huge amount of space and they said, let's push this down and take advantage of the directional price movements as tension releases, trying to get it down to 0. That was their motivator, was to get tension to 0. They wanted to take advantage of that. So that's what motivated the Bears. Bulls moved out of the way, let's drive tension to 0. And then C, we need Bears liquidity or the counterparty liquidity. And so that would be Bulls move, Bears are motivated, Bears get a chance to play, they play. So those are the 3 steps. So keep that framework in mind. All right, this morning, you could see that this comes down here. We get bullish sample, pops up. Take a look at tension. You could sort of look at that and say, well, the Bulls were able to pick up that liquidity into the close, but it was overnight. So I'm not going to treat that quite the same. Things can happen overnight. So I'm not going to look at that quite the same because we don't know what tension actually looked like right after the market closed because the stock market closes. We don't get to see that. So right here in the morning, look at what happened. So let's just get a look at this. Decay flat, and then it starts to move up. So essentially what's happening here is right about here, the market starts looking for buyers to sell against liquidity. Velocity stays down. So right here for just a moment, you can see right there for just a moment, the market is presenting. Let me get rid of that. So you see that came right back down. For just a moment, we had decay flip negative, and we have this bullish right here. We have the tension show up, the trapped orders, remember, it's green because there's sellers. You buy against sellers, they're the liquidity, you sell against buyers. And then take a look right here at that same time. You could see tension sort of curled up a little bit there, but it didn't sustain. So let me get in a little closer, which isn't something I usually like to do, but since this is a little historical, you can see it started to curl up there. So this is a big issue. If you have the market coming back down, the bears are trying to find some liquidity in the market. And you can see right here, the bulls did impact tension, meaning they saw this right here. They bought against it. So this is the bulls. They bought against it. That means they used real money. You can see that because they impacted tension right there. They were not inactive. They did not give a nod to the bears. They didn't go, okay, bears, go for it. That didn't happen. But bears came in. This goes positive here. And we have trapped orders. So this is the liquidity, both of these points together, just like these 2 points. And the bears were able to get liquidity to sell this off down. And you can see right here, the bears impacted this as well. What's the problem? You got to ask yourself, what's the issue with bears doing well here? They didn't get elasticity. They didn't get the nod from the bulls to say, you guys can run this down to zero. The controlling party didn't let go, and the bears again did the same thing they did yesterday, okay? They came in and they said, we're going to flex our muscles, bulls. That's what they did. We saw this yesterday right here. This would not have happened if the bears had not just gone and got aggressive, because the bulls had every reason to run those bears out, and they eventually did. So what this right here is teeth. Okay, you got to get comfortable with this idea if you're trying to chase into a secondary position. This is what teeth looks like. We have the teeth. This move down was the teeth. The original position was way down here. Again, bulls are successful, so they're here. So you could say to yourself, most likely, this position is going to make money. Again, it drips down here, and this is teeth. It's a difficult concept. And that's why when we went into this yesterday, I was talking about the teeth, and what you kind of think is you think, well, where's the best possible position? And then what would it take to ruin that position without taking out the origin of the trade? And the origin's way down here it's lower than that, actually. It's from the previous day into the lows. So this is just teeth. This is eliminating shadows. The moochers, the people who try and buy in and they want to make money too with the bulls. And the bulls are like, well, just don't do anything. They didn't lose control, and you can see that. How do we know the bulls didn't lose control? Look at tension. Where in here do you see bulls having any troubles at all? None. So this is the intention here, is to shake the small chasers, the shadow traders. So when the bulls came in, they got liquidity. What happened? The bulls were active. They picked it up. You could see it right here. So there was no intention here of getting tension down to zero. So you could see this started to project halfway through the day down to zero, but you'd have to be sitting there looking at this going, but the bulls are active. The bears didn't get the nod at all. So the bears came in right here when decay started to rise. They got this. They picked up the liquidity. They impacted the market. You're like, I know the bears are here. I know you're here. But you screwed up. You didn't do it right. So then you see it turns over here. That was right here, and there's bullish liquidity again. So we have two spots, bullish liquidity here and here, and we know they're active. The second spot, look at this. This is really where it starts to get interesting. Look at the second spot right there. Same spot. Look at that. The bullish liquidity comes in, and the bulls take their time till right here. Their impact looked like a failure, but remember that these bulls have a really advantageous position already. Okay, they're controlling the trend. So when you're a bullish player, you're not just looking at little moves. You're trying to control the probabilities of the market to take the trend. So you see they're active here. You're like, good. Okay, bulls are here. You see a secondary position after bears get in. What do you think this likely was? I mean, this liquidity, I'm going to take a guess and say these unjustified bears tried to dump some position here. So they're trying to buy into that. And then the bulls came in when they're about done here. We've seen this structure before. This is that like cheating structure where you have things happen in a way that maybe they shouldn't quite work that way, and things just reverse on them. And it's a little bit of nuance, but what's happening here is the bears didn't do it right. They didn't do it right today, and they didn't do it right yesterday. Now, if you're a short-term trader and you're sitting here trying to catch intraday moves and stuff, you're going to go, but the bears totally won yesterday. And it's like, no, they didn't. It gapped up overnight. The net effect was that they had a hard time. Again, the bulls came in, they had an impact, and the bears jumped in again. Both of these days look to me like bears doing everything they can to push. So it's like 100% push with, let me move my basic, with 0% impact. It's like you did all the pushing, but you did it poorly. And it's, why would you do that? Why? And in my opinion, the bulls are getting the better end of the deal here. The trend bulls, they're saying, well, let them do all their pushing, and that creates a whole bunch of liquidity for us because everybody's going to be chasing that, right? So right here we have our bears, right here we have our bulls, and there's a second pile right there. And the bulls took a little while till the market moved actually above their position, and you could see right in there, right there, the bulls were able to finally get their capital injected. That took a while for that impact to happen, and you could see it stopped that tension from moving down. So a little slower response into the lows. The point is we have two bullish positions, one bearish position. We can make some assumptions here about how this is going to play out. These guys right here are going to need to liquidate. Where do they liquidate? Right here? No. Bigger players wait until they're made to be wrong. Their liquidation is probably going to be, up here. They'll take a little while before they liquidate. I'd say up here, maybe 302. Looking at the ES, I'd say 320, 325. We were able to get up to 320 last night, overnight. So I'd say that this needs to go up a little bit more. I see that there's a spike here, yeah, and that likely has to do with rolling over the bears right there. Sure, but that isn't the kind of thing you see when you see bears dumping their position. Now, okay, so we're gonna be right here. So we have this. Now I'm gonna mark this on the chart with a line so we can keep track of it. And I'm gonna do it on the ES because I like to trade the ES. So right here, you can see that's where that position is. You can see there's some responses there. So this is gonna be where our bears are, and they're trapped in a bad position. Again, it's the same thing that happened yesterday. What saved them yesterday a little bit was that they cash averaged out of the loser. What's different about yesterday and today is they already got out. And we know that because it shot up overnight. It was just, if you go look at the overnight market, well, here, I'll scroll back so you can see what that looked like. So they dumped into that position to get their cash average, and they bought out. And this is the impact of them buying out. And the bulls bought in. That's what happens when you get both players on the same side. So right here, so we have our bear position, and now we have a bullish position. Now the second bullish position down here, I think was a little bit weaker. I think that it was a stretch down. I think the real bullish position is right about right here. Okay, so I'm gonna color that one green so you can see that's the bulls, this is the bears. You can see there's a very tight range here, a very small spot of people trying to act in the market based on what's happening. So we could put another marker here because that, well, let's do it. I'm going to leave it gray though, because I think more than anything, it is, it's a bullish position, but it wasn't the main one that gave us all the information. So I see three positions here spread out. I see the bears again, just like yesterday, trapped, trying desperately to shove the market down, while the bulls haven't given up an inch in terms of control. I mean, look at tension. That's where I'm gathering this information from. You look at the context. We're like, okay, we have some bulls here, some bears here. The context of yesterday's bears desperately trying to cash average out. We see high levels of upside tension, and that's all the bears in all of their strength were able to muster, just a little bit of tension down, and they gained no footing on daily. They're not getting any. They're not making progress here. They're wasting, or they're engaging capital in the market, and failing to impact what matters, which is control over the probabilities of the market. And you can see that in tension. It's just not happening. All right, so right now we had our bears get a sample. You see right here, it shows up. There's our bearish position. Right there, we have the signal. Then we have the volume show up right after the signal. So we could see the bears here. Now we're getting some very small samples. Right here, we have our bullish position. Let's see, right there, it's this little pile right there. So our bulls are getting sampled again. Now you got to ask yourself, what do you think is going to happen? Do you think the bears are going to come in and again cash average into a loser and I mean, they already wasted all their money doing this thing, which is now upside down, by the way. Just very, very hard push. And you might say, well, it moved down. They took profit. And you'd say, these are bears, not sellers. You're getting these two confused. Bears get in to control trends. Those guys were looking for a 3-day move down, all the way to the lows. They got an impulse wave, impulse down, that's now upside down. So do you think that the bears are going to show up, try and cash average into a loser, and then see two bullish positions right in their face defending the backside of the bearish position? What do you think is going to happen? Just think about this for a minute. What do you think is going to happen? This is where we're moving away from hard details, where we're sitting here saying, there's a signal, so buy or sell. This is where you need to look at it and go, well, if you were a bear and you had a big impulse move down, and then a couple days ago, they even cheated and were able to do okay. This is the third time that they've tried to just force the market, just unnaturally shove it with no, it's like they're not willing to get things correct before they try and push the market. And this is a really interesting situation. These are the types of complexities that a majority of algorithms are insufficient, that AI really has a hard time with. This is a time when you look at this and you go, what would I be thinking? An embodiment. You embody that group of people that are bears. And you say to yourself, oh, okay, so these guys right here, the bears, these guys right here, these bears, these guys right here. Okay, so what are they thinking? Well, they cut their ties here. Then they did it again after cutting their ties. I'm having a hard time. So here's what I'm going to do. I think that right now the bulls are getting a little. We just saw two bullish positions potential here. We've got these guys here, and they'll probably liquidate about 320, maybe a little. We'll say this expansion move here. We'll say that would be a good spot, probably. But overnight, 35. This is the overnight high, and I think if you're an institution, it's not so much how far up it is. It's whether you're right or you're wrong. And at some point, they're going to say, we're wrong. And you're going to see that in two ways. You see price slide through their position, and you see tension curl. Because when an institution gets forced up against the wall, they're like, I can't deal with it. They have to unwind across the whole market. And so we see that as they get forced to unwind. Prices move. And then not just prices move. That's not, you see tension curl because they're impacting the probabilities of the market going down are reduced because capital working in their favor was extracted. Their probabilities have just gotten dropped. And it creates a whole different scenario that they're conditioned in the market. But what's important is that you can detect it. So we're looking at tension here. And what's happening is as we hold these bears underwater, which yesterday we should have done, but you remember yesterday I was complaining through this area here. We don't have data points. I want more data. Well, we have enough data. This is not a data lacking. The bears are trapped upside down. This is headed up. We're going up. We're going to wipe them out, and we're probably going to get to 30, 40. I'm just looking at this. We're probably going to push through the overnight highs and get even higher. And I know it's going to piss you off because you're like, but I saw the news. Good for you. You and everybody else. So we're gonna head up. We're probably gonna get through the highs. And who's gonna pay for this move? We can see them. These guys. This group right here. Who else? Anyone shadow trading this, hoping for a 10,000 point move down? These groups who were like, yay, yay. I'm sorry, this was a trap. This whole thing, conceptual trap. And what do I call this? Teeth. This whole situation is what I mean by teeth. So if you're not understanding teeth, this is it. We went through it yesterday. We're going through it right now. The teeth are the capacity for a position, the controlling party. So we could see it's the bulls. The bulls have control. Look at tension. See that? It's the capacity for them to basically sit back and let apparent bullish positions go underwater because they're cash averaging in to a winner. So what you want to do on days when there's teeth is look for the best position, which was, in my opinion, right here yesterday, right here today. Look for it to get just totally wiped out, but it didn't really. And then you want to buy in. That's how it works. That's what teeth look like. So you sort of look for, how do you ruin everybody's day? And then you buy into that. And that's sort of the teeth concept. And it works. What makes it hard is that the signals that tell you it's going up don't seem to work. And so if you're trying to back test this, you're going to run into this one really big problem. It looks like all the signals were failing. But if you look at this in terms of multiple days, then what you're doing is you're understanding what these players are doing, how they're motivating trapping in the opposing party or the counterparty. And then you can understand who pays for the move and how it psychologically abuses the wrong side of the market or takes advantage of how it psychologically optimizes the profits of the winners. We'll call it that. It's euphemistically prettier. So here we've got that. We've got that. Now, one of the things we can look for, I think yesterday, the bulls could have shoved it up, but it looks to me like bulls are willing to put in the blood, sweat, and tears for a longer term trend control. Looks to me like the bulls are willing to put in the blood, sweat, and tears that's required for a longer term bullish control. It looks to me, I don't know how many times I have to say this. So we're trapping in the bears 3 times. We've done this 3 times. We have just ruined their lives. They thought they were winning. They had such a good time. Oh my gosh. Okay, so let's take a look at the tick right here. Does this remind you of anything? Yesterday, oh my gosh, this looks almost exactly the same as yesterday at exactly the same price. Why on earth does it look so similar? Probably because it's almost the same thing, except for the difference between today and yesterday is the amount of data points we have showing the bullish activity. Yesterday, it was like, I was like, oh, I want more data points. Like I would have acted if I had more data points. I didn't have it. Today, we have bulls, 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 bulls. Today's different than yesterday. It looks similar. Conceptually, it is. But today is not going to fold. It is not going to fold. And what we're going to see is that major trend bears are going to get stuck and it's going to hurt. And you can ask yourself, well, okay, so what if we trap a bunch of bears? Well, let's take a look at how much money they had. This is how much money they had. This is how much money they had. Tell me, do you have enough money to shove a market 15, 20 points? Imagine to yourself, just guess what it takes to move a $2 trillion market. And then say, that's probably how much money that's going to have to come back out, right? You put that in, it needs to come out. You see what I'm saying? So we have trapped in the bears twice by letting them get justified and validated, and they feel so good. But they never even gained any. Just look at this, is pathetic. They didn't even do anything. And they got what they thought was elasticity, and that lasted for a little bit. So it could be that the bears were able to pick up a little something, maybe a little bit of money, but it's not going to counterbalance what the market's going to do. It's not. So I think that we're headed up easily, up through 30, 40. We're going to be blasting out the highs here. We can see what happened. This is taking the bear's face, and it's doing this. It's like, no, it's fine. Yeah, I'm fine. You're fine. I'm fine. Bam. It's like waiting and then popping them in the. It's like they waited. It's like the meanest psychological game ever. So this is where we're headed, and we can see this. So I'm going to go over it one more time really quickly so that you can pick up why I'm giving you the attitude I'm giving. So yes, I'm going to start yesterday. Right here, the bears showed up. I said their stops are going to be right up here and that the market could easily run them out. We had a big old fat void of data points through here, which frustrated me because I thought the bulls could do a great job. They had money. They did nothing. And the bears flexed their market, or they flexed in the market. And what happened was the bears wanted out of a loser. They were cash averaging, so they had like an initial position way down here, another one, another one. They're trying to cash average out, get it down to take a break even. And then it got down, they flexed. Right into the close, the bulls got their buy. Okay, so this sets up yesterday. The bears are dumping, getting out, and the bulls are buying. They're both buyers. Overnight, the market pops up. Today, the market needed to deal with this high level of tension, so it tries to start burning. We pick up a bullish trade here, right here, and then a bearish trade here, and the bears again decide they're going to flex. We're such big, strong boys. Our big, strong boys. They push it down. Bulls get sampled again right here, and the bears have the cumulative effect of very little. The bulls pick up the second one after a delay. So it took them a little while, and then you start to see the impact. So the bulls hit and are successful. The bulls take a little time and then finally are able to impact the market. It just took understanding the structure here. Now we have the bears trapped underwater here. I'm going to guess there are a bunch of people probably still holding on to this because it won, and people who think that things that won in the past should win in the future. That's one of those false assumptions about stochastics. It was a winner, so it's going to be a winner. I think the best predictor of the future isn't past behavior. It's past behavior. It's not past price behavior. It's past people behavior. So there's probably a couple people here, but I think this is the big chunk to really pay attention to. And we have another chunk down here. Right there is a chunk in it. So right there. So this is the one I'm focused on. They're not going to liquidate probably till they get about here. So I have that marked. And then obviously through the highs, so 30, 35, because these will be bears who are saying, we won't let go until we're wrong. Okay, so now we have this situation just like yesterday where we have bears trapped. But today we have bulls, and then right here, look, bulls, and the bears even tried to, again, cash average a loser. The bears are doing worse today than yesterday because now they have the counterparty shoving. And you can see that the bulls are picking up tension and successfully hitting. So we're not in the same boat we were yesterday. Yesterday, there was this risk that the bears could flex because there were no bulls. It was like, and hopefully I had talked about that enough that anyone who saw it when it happened didn't make bad choices. So right now, the bulls are showing they'd like to play. They're ready to push, and the bears are again trapped underwater. We are going to liquidate the bears. So that's where we're headed right now. I've gone over it twice. Hopefully you can see the structure here. Hopefully you see why you should be sort of enthusiastic. I mean, after looking at yesterday and the day before, and you follow the story along, you could say, oh my gosh, I see what's going on here. The bears just keep shoving without context. It's like they don't understand. It's like they're not understanding. And it looks to me like the bulls do understand. It looks to me like the bulls are going, well, let's just let these guys drown themselves. It's almost like we have an informed party and a blind party, like an uninformed. They don't realize that there's other people in the world. You could look at it that way. Another way to look at this is to say there are no two parties. There's just one party, and they're wearing two hats, and it's just working in their favor to drive prices down to fill more positions. You could do that too, whichever one's more comfortable. I personally like the drama. So I kind of think, hey, I like to see them fight. So I prefer to think of them as two people. In my opinion, they act so distinctly different that you might as well just think of it as two people with two distinct characteristics. Most professional institutions have buy algorithms and sell algorithms. And I'm going to guess they have people operating their buy side and there's different people on the sell side because they're just like two different parties of people. So we have trapped the bears. The bears have made mistakes. You can look at the price and you can say, but the bears pushed the price. Doesn't that mean they won? I'd say it means they won in the short term, like they won a little battle. But when you look at tension, their big flexing muscles hardly moved anything. And these bulls are positioned well. So I'd be really, 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 really skeptical to hold on to a short right now. I think that you're asking for it and you're going to be playing with the team who's going to do a little paying. Okay, so what's coming up next? What do we need next? Well, what the bulls want here is to try and, okay, so the whole idea here at this point is to say, well, if the bears dump too soon, we'll be driving tension right back up to negative 65%, right? I ran out of room there. 60. Well, they'll be pushing it right. So if we can get the bears to hold on, then price can rise and tension can just kind of move slowly. Because when you have somebody paying, then prices can go up. You can get them to, the transfers to happen without having to actually move a whole lot. So you can get a greater movement without a whole lot of tension winding up in the market. And that's great. What that is investors following the golden rule. And the golden rule is you put money into things where that the thing does the work to increase your money, not you. And so if we can get those bears to hold on a little bit longer, then the bears will do the work to make the money rise in the bullish account. And so that's better. So I'd like to see prices rise and tension not rise. If we get those bears to hang on just as long as possible, then we could get the market to go up and have the bears pay for it. One of the biggest places that I look for to see that is this. I want to see the tick push a new high and price rise without pushing a new high. So if we could get price over this morning, okay, it's not my favorite. I prefer, let me show you a day that looks like something that I like a lot better. Well, this is better. This is pretty good here. So we finally get it over and it retests and it stays above and then it shoots up and then it makes a new high here. Well, actually it did it there too, huh? So this struggled to get over right there. We got a new high, retested, and then it was able to shoot up. And then when they let go of their position, it caused these tick moves. And that was essentially the high, it kept going, but as far as it goes, you see, then it came back down to the tick. So it's sort of this little structure here. So we're trying to trap in that side, and you can see that in the tick, the way it structures with prices, and then you watch for it to rise without the tick making new highs. And that's the objective here. I only have a couple days because I've got a lot of things running in resources, resources. So right now, that's where we're at. We could push above this, sure. It almost seems like the best thing to do would be, at this point, just keep going. I mean, I'd love to see an inversion, which is what I call that whole thing where it pushes. I'd love to see that. But we have bears underwater. We have everything we need to make this whole thing work. So you just go for it. I mean, as long as it doesn't move too quickly, because the faster you move, the more likely those bears will let go, because you want them to not really realize that this is a horrible idea. What you want to do is to make them to go so slowly they don't quite feel that cumulative pain that they're going to feel as we run them out. But if you do that too quickly, you don't get to run them out as far. So nice and slow would be the best. A couple of sweeping pops down would also be nice because that would help validate them, which converts them into hope. And that hope getting validated makes you apathetic, and so you feel nothing. And that numbing of that pain is the best. We got to go from I'm right to hope to apathy. And so right here, you could see we had another little pop up. We have ourselves in a little group of bears. Keep your eye on tension. I don't think it's going to work. I think that the bears at this point need to stop dollar cost averaging their loser and let it go. But I think the bulls are just happy to accommodate them. Andy said, boil the bear frog slowly. Boil them nice and slow. But at some point, they're going to realize that their pain tolerance is getting maxed, and they'll feel. I think you can, like, if you were to map out pain, and you felt it like this, you're going to stop, here. But if you're numb to it, and it's nothing, and then all of a sudden, all the accumulative. So if you took like the all the cumulative to where you do feel it, all of this gets added up. And that means the pain is way higher because it goes from 0 to all of this in one moment. And that hurts way more than if you had just been able to feel it along the way. And that's why you see the big knee jerks of these, because it's like, nah, it's fine, it's fine, it's fine, it's fine. Oh my gosh. And then they get all that weight at once because that's how risk builds. It builds really slowly. It's logarithmic. It's that exponential curves will move like this. Logarithmic ones look flat until all of a sudden they're like almost a 90-degree angle. And risk is a logarithmic type of thing. You're just like shoop, and then all of it at once. And it hurts way more because you go from apathy to no apathy. It'd be like waking up in the middle of a surgery, feeling nothing, and then all of a sudden the anesthetic wears off. They got way farther into the surgery than they would have if you hadn't had any. You'd have felt the poke, and you'd be like, ow, and they would have stopped. But now you're all open, and so this is what I'm saying. Like, getting traders to apathy is important for making further profits. So that's where we're at with this. Good and slow is great. A 45-degree angle is the tried and true. They have 45-degree angle that looks like this. Let me show you. You get a 45-degree angle, right? We'll get 45. And these charts are all logarithmic. It's silly because you squish the chart down and the angle actually goes like this. It's funny. Anyway, it's sort of a 45-degree angle, and you have it where you have the large moves look like this. So you have sweeping moves that move in the other way, but the net move looks like that. So you have like, we have seen a little bit of that. These little pops down. We want the big sweeps to go the wrong way. So you have like a 2-point sweep, boop, but then the grind. And then what happens is you get algorithms that they sum up. So you get like a summation from, n equals 0 to n equals, x right now. And they sum this up and they say, what's the sum of all the strength? Isn't that funny? It's sum of all the strength. So you're adding up only strong moves. You'll add up this one, you'll add up that one, add up that one, this one, and then maybe this one here. So you have one going up, 1, 2, 3, 4. So there we go. Two up versus 1, 2, 3, 4, 4 down, something like that. And this is important because this tells you that the strength is down, and that helps people be wrong. So it's sort of the Simpsons paradox, if you're not familiar with that, where you have where you get this market that is compellingly backwards. And that's why I call it an inversion, because as you're going through it, your emotions will constantly, you need to invert them in your head because you're like, wait. And it's sort of a squeeze. It's like, well, I thought I was supposed to sell. It feels like I should sell. You'll see data points, hundreds of them. Oh, it's hitting a support, I should sell. It's hitting a trend line, I should sell. It's hitting 1,000 things, I should sell. So you get flooded with data points. And why is that? Well, if you're trying to sell liquidity as an institution, you need things that trigger people on the wrong side as markets trend. You need that because you need to say to your customers, I can guarantee you volume. And they say, well, how can you guarantee that? I sell people things like EMAs and stuff. And I tell them to do it in a certain way. And then when you need that volume, you can count on it. The only way to distinguish between a time when you're being used as liquidity and a time when, you have the random probabilities, which is a 50-50 chance that a trend line will bounce. It's 50-50, and that's the best you get. You will not get up to 62%. That's silly. Even then, it's still random. So you get this 50-50, but then the only way to tell when it's not 50-50 is if you can see what institutions are doing. Institutions will define when the markets need liquidity, and they will consume all those signals. Right now is when the signal traders are getting crushed. You should have friends and Twitter buddies that are posting about how that they're right while that they are underwater. In fact, you should see people posting about how right they are, because they're getting to the point where that you have to choose between taking a loss because you're wrong or fighting for that you're right. And people, it's logarithmic. They'll fight until boom, and then they'll go quiet. And you'll send them a message. You'll say, hey, what's going on? I was following you. What happened? And they won't respond to you. It's like, why are you responding to me? Or they'll dodge the question. They get all dodgy. And you can pick up on it. You could say, oh my gosh, you were wrong. You got pulled in. Your philosophy was used as liquidity. It's really, straightforward. If you can track where these institutions are, you start to see it. And then you can observe people actually playing into providing the liquidity when these markets ask for it. And what you want to do is step back and say, I'd rather trade less to only trade when institutions are doing this so I can get larger runs with bigger positions. Because if you trade with an institution, you can go up to 100 contracts because they're trading significantly more money than you are. And while 100 contracts still represents $1.3 million or so in the ES, they're trading all over the place. The market can support you. If you're not, then randomness will wipe you out. Randomness has this way of stopping out everybody. And so you got to pick out where institutions are first and trade with the narrative they're working around. And if you don't think narratives are how it works, what are you living under a rock? Narratives are step one in all of politics and money. You build narratives. And then you operate from that narrative, whether the narrative is completely true or completely false and stuff like that. So we're tracking the money and we're building the actual narrative because it's supported by the data points in the institutions. We can see what narrative they're working with, not the one they're selling you. And so that's what we're sitting here doing. And that's how we pick this whole thing apart. Hopefully this makes sense what's going on. Hopefully it's not that you're going, I see X, Y, and Z happened, so it needs to go up. Hopefully you're saying, I see how that hurts. I see how the bears probably think wrong right now. I see how they're being emotional. I see that dollar cost averaging into a losing position is a horrible strategy, especially when you have the winning controlling party, bulls, buying. Okay, so done with my rant. I think I'm trying to put this all home where sorry, somebody just put, Berger just posted he had a dream about being scared of 100 contracts. It makes me laugh. It makes me laugh not because he was scared of 100 contracts, because after a while you can dream and your brain has this way of communicating in market prices. And you know you've stared at enough charts when you dream in charts. And I laugh at that because dreaming in charts is like, it's like language. Like you dream in a language after you've been learning it long enough. After a while, I started dreaming in charts and I don't even think about it now. It's just how I interpret things. Anyway, so again, we've got these bears here and look at their impact. Take a look at tension did not move in their favor. They didn't even hit price. This to me looks like the bears are either very slow to act. You know, we could see it moving against a large position isn't that big of a deal, but they're not having an impact here. And it's not that they're not, it's that looking at the whole narrative, this whole amount of time, them not hitting right here, right now, looking at tension, not doing this makes me think, I think you guys have pieced it together. Yeah, I think you've pieced it together. I think they're seeing what's happening. They're on the wrong side of the table. What's interesting here is that, what are you going to do about it? Let me guess, you're going to wait for the market to come down, take a break even. You should have. The market was generous and gave bears this, in my opinion, was just the market gods coming in and being kind to the bears. That never should have happened. Or maybe it was just the bears are fighters. I don't know. But in terms of price, the bears already got their one chance to get out, which was yesterday. And sure, you could say this, blah, 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 but no, that was this. This whole thing was, you could not have counted on it. It was just bulls being, they let them do that, and then they're crushing them, and now it's going to be pretty clear. What's important is that these players are not playing for intraday moves. They're not looking for 10. They're not looking for 20. They're looking for 100, 150, big trends. And don't take this to mean the market's going up 100 points. It's just that's the scope of what they're thinking. So if they get this to move up a bunch and it's going, and they see that the market start to crumble on the inside, they see tension start to have a hard time, you know, moves under 30-minute maybe came down. They would look at that and they would say, well, we're losing control of the major trend. And then they would dump. That's what gets them out, is not because price moved unfavorably. What gets them out usually is when the market conditions are clearly not in their favor anymore. So their size is enormous and their control, their scope is that of control and probabilities, not necessarily what you're looking for. And so as long as they have control over the market's probabilities, I mean, they're going to continue to consume one side of the market. So that's where we're at with this. And so I think going into the close, since we have about a half hour left, what you need to consider is that I think we've got some pretty good concept liquidate up to this. And I picked this spot because there's like an expansion bar here where it popped down and didn't retest. There's some other ones maybe a little higher. Here's a pivot, could be up here. The point is, I don't think it's going to liquidate these bears until it gets a little higher. These bears thought the world was going to end. They got very validated here and here. So they moved. So they were in, this was fear, right? Trying to, this was a scramble to save it, fear. This right here was validating. Well, it was fear here, and it converted into hope, and then they pushed, which validated. So I think in here was hope. This right here got them to move to apathy. And again, it gapped up, and the bears had hope here, and I say that this was hope without fear because they executed a big trade out of nowhere. They were validated, and they turned into apathy. Because validation turns hope into emptiness. You can't, once you're hopeful, and what is hope? Hope is where that you have a trade that is wrong and you should never have done it, and the market validates you. And what happens is you take the responsibility and you hand it over to the market. And you say, oh, I'm right, good. And then you're no longer responsible. And so you shut your brain off, right? Don't you? You shut your brain off. You go, oh, okay, great. And you say to yourself, my decisions cause money. And you're not responsible for everything in the middle. And the market says thank you. And then as the responsibility is being stabbed and stuff, you don't feel it. You don't feel it because you got validated. And now you're empty inside and you don't feel the pain. And that's when you get the logarithmic curve. So if you've never been through this, you need to trade longer before you start seriously considering like sizing your positions. You should be very familiar with the process of being converted into an apathetic player who can't feel the market pressing against you until it's too late and you bust and you lose it all. They're going for margin calls here, not stops. Now, institutions don't really have margin calls that are likely reachable. So what they're going to do is push until their institutional tolerance is forced. Institutions basically, they say you're not allowed to margin call your account. We have rules because our investors, which is people who don't know how to trade, are investors. 401k accounts have tolerances. So they have certain tolerances. If there were no tolerances, the bears would do what you do, which is let the market margin call you, because humans are the same no matter how you scale them. And you're not even scaling them, you're just scaling their accounts. You have $1 million account, this is your first day trading. I'm sorry this is going to cost you $1 million because typically you have to lose pretty much everything before you actually get it. This is not about numbers. This is about people. So they have tolerances because obviously. Anyway, so we're going to run for those tolerances. I think they're set pretty wide. I think bears are apathetic. I think we're headed up. I think we're going to be getting up easy through 35. Unless some sort of condition changes, it's not. So what is this going to look like tomorrow, going into the close tomorrow? Well, if we can get tension to sort of close right about where it's sitting, okay, then what's going to happen is that tomorrow we could gap up. And there's a little bit of room in terms of, I mean, I would say 80% counter tension, 80% force here, which is probably sitting somewhere up here. You know, this was 65, maybe a little higher. That's how much room the market has before the counter forces just turn into lead weights, right? It's like, and so I think today the market sort of bears tried to eagerly run an elastic market and just failed. Maybe it was because they knew it was going to fail. And so they thought either you push now or you don't get a chance to push. Sort of like if you have at the wedding to the ex-boyfriend, say something now or forever hold your peace. So they said something because they were not going to be able to do anything later. So we have a little bit of room to the upside to run. I know it looks like there's not, but there is some room. It is possible. So let's consider what would be best for everybody. What would be the best case scenario here? Well, I think that at this point, again, we have the bears in a situation and we have data points to support it. Yesterday, didn't have those. That right now, the best case scenario would be to maybe slowly grind this up into the close as just this distance here, maybe even a little higher. Just, it needs to be slow and painful. Painful if you're not apathetic. If you are apathetic, you've already deleted your stop and you're saying things to yourself like, well, I can't trade tomorrow because I already lost too much money. So hopefully I make money and I can trade tomorrow. We'll just leave it up to probability. Maybe randomness will save me. And randomness will not save you because this is not random. It just looks that way because it's squiggly. People get that. Squiggly isn't random. It's enough random to make people think it is random. So we have, that's what's going to happen there. So I think the best thing, if we push this down, let's consider if bears won. Let's say they push this down and market closed down here. Well, the first thing that would happen is we would have to sample the bulls because this would trigger, it would almost immediately sample the bulls. And we would have to ask the question, are bulls going to step out of the way? When they get some liquidity right now, would the bulls just not fill that? And the answer is no. So first thing is that the bears would need to be able to sample the bulls and wipe them out. And currently they tried to do that this morning and that didn't work and is getting expensive. So right now, would you as a bear say, well, let's go ahead and do some selling and let's hope to the heavens that the bulls who have expressed themselves 4 or 5 times today are going to suddenly have a change of heart? Is that reasonable to you? Do you think that's a reasonable thing to think? No. It's like a brick wall. So I think scooting this down right now is like the wrong choice. That's what it is, the wrong choice. So I don't think that that's a reason. I don't think that's rational. And since the bears are clearly not rational, maybe they'll try, but it's not going to work. So I don't think it's a rational thing to do. I think the rational thing to do is the carrot on a stick, right? Get it as close. Get that. So there's this concept in human psychology called, I call it it's the gap bias. I can't remember the name of it. Maybe somebody, but it's when you have a piece of information A and a piece of information C and you're missing B, that the closer these are together, the apparent how close they are to each other is what drives the whole concept of like mysteries. It's that you want to say there was a killer and there was a guy with a bloody knife. Was he the killer? And you see how those are just so close. It's almost like, well, he has a bloody knife. And you're like, but was he the killer? Right? It drives the mystery. It's like getting him close. And I think that this is playing off of that bias. Get it really close to sampling the bulls and failing. It's just so close that it's tempting for the bears to try and participate. So I think we could potentially just people trying to take advantage of the fact that it's close instead of trying to take advantage of the data point and like the update of your expectation, the scientific model. Instead of taking advantage of that, people say, well, because it's really close, it's really tempting. And I think this is the carrot on a stick model. You get it, you get that signal so close to you that it's hard not to just start having your mouth water if you're a bear or something. And if you're stuck in a position and you're saying, I'm willing to cash average into a loser, well, getting it nice and close may encourage you. You'll say, well, if it moves down, I won't get as high a price, right? If it moves down, I could get 30.17, but to sample those bulls and then we'll push through them because I know we're going to push through them because you're being biased. I wouldn't be able to get to like 30.15. And it's funny to me because when you're being emotional, it's like you can't consider the fact that you're wrong. You just consider the fact that you're right and what advantage do I obviously have right now. And it's like this bias. It drives me nuts. Anyway, so I think that's how the carrot on the stick works. Get it really close to giving you that signal that could fail to allow you to just be as biased as possible and just sort of grind it there, like grinding against that feeling. So I think the best case would be to just to milk that. Keep this just until you have to, and then you'll see that push up, and that push up I think will be that final shove up, and we'll keep an eye on tension. If tension curls up, if it did that, you'd say boom, they just liquidated. And then you want to look at price, and price will probably sweep up a bit, and then you say, okay, there it is, they liquidated, they got those dumb bears. And overall, we're looking at all the context, but the objective here is this is the end goal. It's not the most important. It's just this is the part that lets us validate components and aspects of the other tools. What's the motivator? Keep tension down. keep it as low as possible, near zero as possible, I guess. Because if it shoots up and we start seeing numbers like -80 tomorrow, we're gonna be in trouble because it's like, it's getting kind of heavy and they'll need to deal with it. So we don't want to get it too hot because then you run into other issues and it can change the context. But in this context, I think the market's probably going to get pretty hot because the bears seem to be aggressively just on the wrong side of the market and they're cash averaging a loser, which is the worst idea. Okay, so we have our last 30 minutes in the market. There is a couple of groups that need to come in and deal with this. You hear the term rebalancing, and I think that's a confusing term because it doesn't really tell you what's going on. I think, some of the traders that I work with here, the market on close, I think is a good number. It gives you, people who are market on close for the most part, what you're trying to look at is those orders that can't hold overnight. You don't have enough money in your trading account to hold your position overnight. And even worse would be if you're at a limited day trade. So I think there's Thinkorswim's like 3 day trades and then they spank you or something like that. Send a guy over to spank you, ugly guy. And what happens is if you're on your 3rd day trade, you don't want to get spanked and you don't have enough money in your account to hold overnight. Do you see the problem? You have to close. You can't just bend the rules because if you do, you get in trouble. So the market on close number, in my opinion, would be a standard deviation distance. And when its standard deviation is too high, I think you have a group of people, a large group of people, who are stuck and forced to close their trade. So I like that market on close idea. The other idea would be those people who are looking to trade the market and provide just volume in there because it's beneficial to companies like BlackRock. Anyone providing a security for people to trade. They want to say, can you make our stock look like everyone trades it? Or can you provide enough volume in the market so people want to trade it? They don't have liquidity issues. You have this group of people who sort of do that. At the end of the day, in my opinion, when you say rebalancing, those are the groups I think of, not the market on close people. It's the people who are like, well, I was trying to just trade a neutral account. I didn't actually want to end up with a balance. I just wanted to pump the order book so it was full and people would feel confident and stuff like that. Oh, okay, so Andy's telling me that there's still both sides for the market on close. So I think that when you say rebalance at the close, those are really the 2 big groups you're looking at. If you're thinking dark pools, well, they don't show up in the market on close. They don't even have to report. It's like they didn't even really irritating to me because I think the logistics of dark pools is at best really shady, but they don't have to really report. And so it's like, well, if you didn't have to report, how did they know to fill your orders? It's like they're reporting it to the people who need to accumulate the orders, not to the public. So they did report it. And in my opinion, if you're reporting it to someone, if you reported it to Thinkorswim and Thinkorswim filled a couple orders to send into the dark pools and then it's like you reported it. Why are we letting them report to only the people that give them an unfair advantage and not to the public? I mean, do you see the problem? So those guys aren't going to really show up in the market on close orders. They may show up a little bit in that maybe an institution might do certain things to cause certain things. There might be some, but in my opinion, the market on close is not going to expose much detail about dark pools. Not enough that I think it's a reliable place to really put your eyes to decide that. You need to look at those alternative network, the alternative network places for dark pools. Now, I think that dark pools are an okay source. The reason I stopped watching them was that I can see what institutions are doing, I think. And I've got this thing, and it is nice to have a validation, but I didn't actually think the added cost of observing and eating up resources to observe dark pool orders was adding enough value for me to do all that. And I do think it's a good thing. And also you have to consider that, I interact with a bunch of people. And so usually I hear stuff anyway. So it's like, I was already kind of getting some information if there was things going on. And so I'm like, well, I don't know if I want to consume resources to add this little bit of value that, is there. So that's why I don't really track it right now. I do think it's a useful thing to track. I do think it's helpful. So I'm just trying to describe at the market on close who I think these groups of people are, and make sure you understand that dark pools are something that happen outside of the scenes, and you don't really get to know about them until the majority of what they're looking for has already happened. And the fact that there's a 24-hour gap between their reporting cycle tells you that it would be really advantageous to take most of your profits within 24 hours. Because as soon as that happens, as soon as everybody knows what you did, it really is going to limit how much you can take over the short term, unless you're looking for really long-term trades. You should basically have taken all the money you're looking to take before you have to report the thing. So I think there's this huge precedent for moves to last less than 24 hours, if not much more than that, because of this whole, the way the dark pool system got set up for whatever reason. So I think having those, the last half hour here, these are the groups that are fighting. Dark pools they seem to fill oftentimes right into the close, at least on equity indexes. That's what I think. Then we have rebalancers, people trying to do net neutral position. And then we have the group of people who are forced to close because of their financial situation. So at this point right now, what I think is happening, we're getting some moves down, and we're getting those moves, and by moves down, I mean these sweeps that we were supposed to be looking for, the ones that help you accumulate. The strength is on one side where that things sort of pop down. We're getting a move down. Now, take a look. We have right here this pushed up. You have that red dot there, and you can see that red dot, and then we have this here. So we've got another bearish position here, and it's grinded against it. Now it's kind of coming back down. This would be I can mark these. It's just a little messy looking at that. We'll mark these. So here's that previous one. Here's the next one. And then we have the one just before that, which is this one here. And you might even look at this and say, well, it moved. This was a pretty significant pivot. This was a pretty significant pivot right there. So moving back up, you could look at these as dark. I think contextually that these do not look like really good decay retests. Maybe yesterday's highs I would look at, but it's a long ways away. So we're getting this dipping down. So I marked out the bearish position. So the reason I did that is because it's like, these are the guys you don't want to let out, but they're cash averaging. So maybe the middle of them. So right about here, if we added all three of those up, if we marked out the cash average of that would be probably about here. So let's do that. Let's do that. Let's say that that is about the cash average of their position. This is dipping down. We're getting decay, again, sampling bulls. So that's the third time. Up here, we had a bull. There's three of them up here, and they picked up those two. We're on the last one. We're going into the close. So what's happening is there's a big time crunch here, and this is where I think the market is going to be looking at that. But I think that still it doesn't make sense for the market to move down. We don't want to let the loser out. Yesterday, they flexed because the bulls hadn't done much. But today, flexing, I think, would absolutely be a great way to spin your tires, exert all your energy and ability to fight, and the market will get predatorial like crazy. Remember the rule about predators? In all the types of predators you can think of, predators like easy targets. You don't, if you're a big predator in an area, you don't go after something with claws. That's just the worst, because things with claws will hurt you. And if you're injured, that can ruin your ability to be a predator. I mean, so what you do is you go for things that don't know who they are, they don't know what they are, they don't know where they are, they're confused. You go for things that are weak and easy to kill. You go for things that can't compete with you, or you go for things that are convinced they can't compete with you. And to this point, if the bulls are going to be predators, what you want is a counterparty who is exhausted. They're the easiest targets. That's why that's why I'm always talking about you convert from your confidence to hope to apathy. And you do that with some validation in there and things, because apathy makes you an easy target. You don't feel the pain of the market crushing you. You're numb. And then your risk shoots up and you're at rock bottom and you're forced to fill. So, okay, so it's moving back up. I think the bulls are just kind of stepping in, letting the bears sort of tighten the noose there. But I think the bulls are helping this at this point. Yesterday, I think the bulls were just waiting and just going to let it play out. Today, I think the bulls are here going, okay, let's just tap it a little bit, just boop, boop, boop. And they're helping it along, and here we go. So we're about up to 20. We're about up to that 21 level that I was looking for, and that's going to be the first spot where I think liquidation would make the most sense, because we're we're closing up. It's almost like a reverse gap close where you're coming back to the open, but because it was an expansion bar. So there's our level 20, 30, 21, 60, well, 67 is 30, 21, 50-ish in that area is going to be the first spot. Now, what I expect to happen when we get to our first spot is pretty straightforward. If there's people who are buying to look at that, or if sellers who are stuck, we're going to see some transfers there, money, people moving around. That's what happens at these things. We could see a response. How do we know if the bulls dumped? Okay, how do we know if this, when I say bulls, I mean, how do we know if these guys and these guys and these guys all got stopped out when we get there? Well, how do you distinguish that? Is it because price moves? No. Look at tension into the close. If tension curls up, if we see that curl up, then we know that they unwound their position market wide and it went, and we see all the stock probabilities move and the index probability curls. That's what you're looking for. That's it. That's what we're going to see. We get up to those levels. So here we go. We're pushing through into the close, and then we're probably going to be able to get to the next spot pretty soon, if not after the close. Now, how come not just let it go sideways today? It's like, well, we got them trapped in. We could see the bulls are active today. Yesterday, it was like, I was so annoyed because I thought it was such a good situation. The bulls they refused to give us liquidity. So today we are seeing them active. We're up to that first spot. The next spot, I think, is pushing through the overnight highs, and on past there is going to wipe out so many people. Just think of the people that you personally know who are convinced that the world is over and it's dying. And I was just having a conversation earlier today about this, and it was the reason that the market's struggling to go down is because it's overinsured. Sure, that's one. But it's like, but what's the reason? And it's simple. It's so bloody obvious. To anyone who flips on the news, it is obvious the world is ending. It is so painted so thickly in such basic child language, 3-word sentences, the world end. It's so blunt that too many people know the world is ending. In my opinion, that is so that's why I think so many people are going to get in trouble here, is because you're not just going into a narrative, like a complicated, you're going into this big blunt instrument. Is like walking into a baseball bat, not a scalpel. It's like this big lead Thor's hammer kind of blunt instrument with lots of force, and everyone's doing it. So you have this big herd mentality based on this really dumbed down, simple, obviously wrong narrative, but it's very scary. And we know that because you go to the store and you see people with a mask on. It reinforces that narrative. It's really hard not to hear. It's hard to live under a rock right now and not hear this narrative. Is the narrative right or wrong? I don't really care. But in terms of financial markets, it's too blunt. It's too loud. It's too obvious. It's over the top. So who's going to get blown out of the market? Money. It's just, there's a lot of money up there. Of course we're going to 30, 40. There's just too much stinking money. Okay, so here's what we're looking at. So we have the market creeping up into the close. Why is it creeping up? Well, we've been talking about this. I'm trying to get this narrative in. So you could say, how did you see that coming? And this is the email I get the most. What signal did you see? And I need to respond, and I'm going to try and hammer this home. None. This is not about a signal. This is about the context, what's going on. How did you know it was going to rise into the close? The last 3 days. So what's the complexity on this? My opinion, you could call this actually a little simpler complexity, maybe, because I think you could have come to this conclusion just looking at today, but that's not as fun, right? Like, I don't want to make this about, like, I want you to see the whole narrative. I want you to hear all my thoughts so you can hear the last couple of days. And so I would raise this up to maybe medium complexity, but you could think of it as high because I'm tracking the last 3 or 4 days. I think this has everything to do with the bears cheated last week. They're still trying to save themselves from that horrible situation. And they're like, but we won. And I'm like, but the price you pay for making money inappropriately is always significantly higher than the money that you make as an emotional cost. Cheating costs you more over the long run because you didn't learn it right and you taught yourself a wrong lesson about money. Unless you're willing to cheat bigger and bigger and bigger and lie more and more and more, which is exponential in markets, you will lose over the long run. And I think that's what's happening. We're seeing that it wasn't about lying, because both sides seem to lie, and that seems to be fine with traders, I guess. It's about cheating, and cheating means you took money out of the market using insider trading. As far as we can tell, it is illegal to take profits without risk. That is a fundamental in all of trading. Nobody should even attempt to take profits without risk, because it's fundamentally bad for everyone. And I think the bears cheated. They took some profits without risk, and now they're going to pay the price. And I think everybody in the whole world who has any idea about infrastructure and stuff when it comes to finances really wants to see those guys pay. You can't learn that lesson. I'm sorry. It's not fair. It doesn't work for me. So looking at this market, I see that's what's happening. We're seeing some like social justice. We're seeing the bears pay the price for making money by cheating. We're seeing this game was not a fair game over the last couple of days, even though, yeah, sure, the bears brought prices down. But if you're a trend trader, I'm sorry, it's like, well, oh, so this is discretion. The bulls are choosing to punish the bears. And it's like, no, but they're not going to do it. So I think that's where we are. I think there is a ton of whispering. I don't have to listen. I think there's a ton of whispering going on in the financial world. You should sell the market, because I think the bulls would like a little social justice. You're messing with the game. Play the game, hate the game, but don't break the game, because taking profits without risk breaks the game. It's not that it's not fair. Sure, I'm all for anybody making money, however they got to do it in the world. I can't blame people for taking big piles of cash. Not even a little. I would do it. You should always sell out. Always. Somebody offers you $1 million and you don't have lots of money already, you should take the $1 million, because you're never going to get that chance again. But in this case, they're breaking the game. And that's an issue, because you're upsetting a lot of people, in my opinion. It's like, do what you got to do, tell narratives, buy out news stations, lie to as many people as you can, but you mess with the game and you get people saying, you're going to try and break my game. This is my favorite game and it's my livelihood. Although these people aren't fighting for livelihood, they're fighting for other things. So I think this is a little social justice. Bears cheated. They cheated successfully, but not anonymously. And that was their big mistake. They should have, I think, allowed the market to collect more bulls and make it and establish that the bulls were screwing up. And maybe if they could have painted a better picture that at least looked like they were trying, but it wasn't working. So I think that's what's going on here. That's why I think that the bulls are willing to put in the blood, sweat, and tears that it takes to control a major trend. They have let the bears state their case. The bears are wrong. The bears stated their case here. The bears stated their case here. The bears stated their mentality and case here. And they have stated it and stated it and stated it. And over the last couple days, it's just this whole thing. It's clear they are wrong. If this were a court case, I think the judge is in. The judgment's in. I don't think this is trial by jury in markets. It's just the judge, whoever that. I think the judge is more than anything is a body of judges, more than a jury. I think it's in. It's in. The numbers are in, and the bears are wrong. Bears are on the wrong side. So that's where we're at right now. We can look at this tomorrow. I think that gapping down tomorrow a little bit would be just fine. I don't think the market should pop all the way down to 300. I don't think that we should be letting these bears out. Any stragglers who didn't liquidate themselves into the close today, sorry, I just don't think we should let any of them out. Not a single one. Yesterday was okay because the bulls hadn't made their statement. Today it's not okay. And let me make this really clear in the last 10 minutes. If you have a judgment and a sentence passed and the criminal is set free, there's a really big problem. My understanding is that if you're standing in front of a judge and they say you go to prison, they don't send you home first. You go straight to prison. And I think that's where we're at. So if we have a case where that tomorrow the market gapped way down and let anyone who didn't happen to liquidate today out of the market, I would be like, what the crap? And I would I would have problems with the system itself. I would say these were the cheaters. We needed the social justice. We had the judgment was in. Everything was working. Why did you let them out? And you might say, because big rich people scratch each other's backs. And I might say, sure. But not this time. So I think that moving back down tomorrow would be upsetting in that we have all the data points we need to make some sort of conclusive expectation about where this is going. So I think gapping down a little bit's fine, but gapping down a ton going to the middle of today, I'm not as okay with. I don't think that should last. It shouldn't stick around. I think what the market needs to do is surprise everyone with a gap up, a gap and go tomorrow would be the best case scenario that makes the most rational sense to me. And to do that without really pumping tension too much. I mean, how beautiful it would be if we got a gap up tomorrow. Advanced decline was like, wait, let me mark this out for visuals. If we got a gap up tomorrow, tension was just like here and moved like that through the day. The advanced decline here was just like plus 1,000 at the open. It'd be like, oh, that's so great. That's beautiful. We could keep going with these numbers. That would be great. If we open up and it's 2,500 on the advanced decline, it's like, oh, you've already hit your ceiling. We're going to need to do a little fancy footwork to make this happen. It means we'll have to shift over and find a new mechanism to rally the market tomorrow. That's where we're at. Okay, so if you want to know what I think is going to happen tomorrow, I think that's the most sensible thing under this market condition. And the data set I'm using is all the way back from Wednesday back to last Thursday. This is the scope of the data set I'm analyzing. When it comes to how did you know this was going to rally into the close, that's the work I had to do, was understand all this. And not just understand it, I had to be there. You have to feel it. You got to understand what the feeling is. You got to know that the bears are pissed and they're frustrated or they're apathetic. You got to feel that. If you're not willing to do that footwork, you don't have a backbone. You don't have the spine to trade. And if you're not willing to be able to consider the opposing party and to muscle through them while you're in a position, you don't have what it takes. You need to be the kind of person who can cope with the opposing party having a case at the table. It's just how it is. There's no hoodwinks here. There's no surprise arguments. Occasionally, like yesterday, but that was sort of tolerated for. We didn't have the data points to really. Today we did. They didn't. There was no case. There was no contest. This was a relatively conclusive judgment. I don't feel like there was a whole lot of leniency here when it came to saying this is where it's going. Yesterday, I had a good idea, but I hated they don't have enough data points. So if you're going to watch yesterday's, compare it to today's, and see the difference in the way that I was, treat me like a bull, because I've been bullish through this whole thing, trying to consider the counterparty. You could see how frustrating yesterday was for me. Just watch me through it. I was frustrated out of my mind. I wanted more data. We finally got some data into the close that was much better. And then you can see that today pushed and pressured anyone who chased even that data. Think about what that means. Somebody who waited for just the right moment into the close yesterday with all the pieces, even they got pressured today if you were trying to swing this market. This market is set up to run. Plain and simple. We have all the pieces in place here. We have just the right kind of conflict. The narrative was thick enough. It was frustrating for everybody. It was up, it was down, it was right, it was wrong. So we have all the juicy parts that we need for the drama that causes. And so when you think equity is trust, the statement that I have right on my homepage, equity is trust, it means that you had to understand this and trust that the bulls would rationally wipe out the bears today. If you didn't trust the bulls, it has to do with two pieces. One, you didn't understand the narrative well enough. Or two, you don't think the bulls are rational humans, you think they're algorithms. And I think that's a narrative that even traders pitch to each other. It's all algorithms. It's all algorithms. And the reason is because you can't trust an algorithm. You can't say, this is correct, I'm right. Algorithms aren't right or wrong, they're just on or off. And they're on or off based on whatever the programmer put into them. So at best, they're a representation of the limitations of whatever program wrote them. And I just don't think it's algorithms that are controlling this. I think it's people making choices. And you had to trust that the bulls were the ones making the choice. You had to trust that the bulls knew what they were doing. You had to. So the fact that you can trust an anonymous party across a data set worldwide is the most intense amount of trust you can ever experience. And when you're doing it, you'll know what I mean. The money you're pulling out of the market is fundamentally based on your understanding of truth and your trust of the party you're playing with. If you don't trust your teammates, you don't have the money to make cash in this market, not real cash. You don't have the money to run a trend. You have to trust strangers unless you're a big, fat worldwide institution. You don't have the money because you think money comes from buying into lows and holding. It's like, you don't even do any of the work. You don't inject capital into the markets. You don't fight off bearish ideas. You don't defend against things happening all over. You don't do any of the work. You think that you just buy in and ride. It's like you living in your mom's house. It's ridiculous. So you have to trust them. You have to. You're forced to. So I say equity is trust. I'd say you had to trust that judgment. You had to trust this whole narrative. You had to figure out what the bulls were doing. You had to see how it was playing out. And I think my favorite time to trade is not once you see the narrative. It's when you see the narrative, you understand what's going on. You see sufficient conflict. And then you see those moments where it's like, it's clear what's going to happen. And then you could start taking position. So that's kind of how we got here. How did I say it was going to run up? It was very, rewatch it a couple times. See how we're piecing this together. See how it works. It's similar every time in the way that a court case is similar every time. Not in the way that each court case relates to each other. They're all different. Every trend is different. All of them. So it's not that you need to study one particular trend to figure out how they all work. It's that you need to understand the system they're operating in so that when you see events, you can say, I know what this means. And meaning, and it's very frustrating because you want to say, I have a thing that points up or points down, and you just buy. And I think that's just arrogant to believe that that's true. I think it's silly and arrogant, as though you could go into a group and have a thing that just says statements about people. And once people realize what you're doing, your effectiveness drops to very low. People don't like that. It's not how the world works. You got to understand the system so that you can see the people and understand their intentions. And then you can get there. So I think we saw the intent today into the close. It was a good run. Hope people were able to take advantage of it and ride this up, seeing how it was built and what was happening, where we were headed. We're at 31 right now. I still think 30, 40 or higher is in the works here. But with the scope of today, because we're just going to go into the close and then I'm done, which is 2 minutes. We reached our targets. We got what we wanted even further. We're headed towards the overnight high, which is the highest target that I think the market could go to, or that the bears will be forced to reckon with the fact that they're wrong. And anything beyond that, I think, is going to have a scope that's going into tomorrow. You're going to need further analysis to justify anything beyond that. But I think you got everything you wanted. You should cut your profits here unless you're intending to swing trade for a week or so. Otherwise, you should take your profits. We'll come back tomorrow. We'll do this again. You can enjoy some profits tomorrow by keeping up with the narrative. So markets are about closed. I hope this was useful. If you have questions, because I'm talking too fast and I'm not keeping up, I didn't have my YouTube thing open today to watch the chat, which I apologize. Okay, there were some people. Let me quickly look at that. Jeff, if you're still watching, I don't have something to track the dark pools. So the way that I track dark pools is not actually by looking for dark pools. I look for other things that basically I feel confident enough that I know what institutions are doing. I already know what they're going to be doing in the dark pool community. Is sort of my position on that. I could track them, and if you want to know more about where you could look for dark pool stuff, you could shoot me a message. There's a lot of places you can go find that stuff. The point is, I have a lot of limited resources on this machine. I have like 2 computers running, and I'm like, well, I don't think this is benefiting me as much as I would like, so I'm not going to eat up resources for it. But I don't have tools that actually physically track dark pool orders on what they call the alternative the ADF and the alternative something networks. The alternative networks is what they are. So You can go look those up. You should probably learn about them before you try to use them. Make sure you understand what they are. The CME and the New York Stock Exchange both have a little, very sparse information on them. There's like a paragraph maybe or less. So you can look at that. If you have questions about this, ask, because I'm not trying to explain a buy signal. I'm trying to explain a story, a narrative. And the most important thing you can gather is to think a little differently about this. And hopefully it was useful. If it supported your tools. I mean, for me, what it seems to be the best thing is you figure out how it was working, you get your favorite tools, and you try and take advantage of the narrative that's playing out in front of you using your favorite tools. That would be the easiest way to go about this. Pablo, great. Pablo says I did a very clear and accurate explanation. So I'm glad it was helpful. Replay is saying that there's flash, there's light speed, or live vol does exchange dark. It's ADFN. That's right. He had ADFN. So ADFN, which is an acronym for something, but essentially it's the alternative networks, the alternative filling network, alternative something. I forget. I've already forgotten. Amanda's not happy. Sometimes I make Amanda mad. Okay, so she showed up in the Discord. She's not happy. Sometimes she gets mad. So here's where we're at. I've given you sort of the thoughts on tomorrow. I think that a gap and go is the most rational thing, but that would only be possible if we can get that advanced decline to open correctly. Too much of a move down would upset me, because I think letting out those bears that we have worked for a whole week, almost a week worth of data, a week worth of narrative, would be a huge waste. We've already gotten to the point where we've gotten to that point. So if we move down too much tomorrow, I think that would be very upsetting, and I would start to ask some real important questions about the system and what's really going on here. Otherwise, I think that we're looking at the bulls taking complete control of the market. They've done the work. This is not a bullish move. This is a bullish trend. That's what we're seeing right here in today's close, and why I think that works. So that's where we're at. If you have questions, shoot me questions. You get a hold of them on Twitter, get onto the Discord. Good luck trading, guys.